want to move on and talk about the fast-moving ETF business in general. Now, last Thursday, WisdomTree launched 2 new portfolios, model portfolios, designed to challenge that traditional 60-40 stock bond approach. This is the Siegel WisdomTree Global Equity Model Portfolio. It's a mouthful. And the Siegel WisdomTree Longevity Model Portfolio, developed in collaboration with our star here, Professor Jeremy Siegel of the Wharton School of Finance. Jeremy Siegel, you're trying to address 2 persistent issues, lower interest rates and lower U.S. equity returns. And you say the traditional 60-40 stock bond portfolio isn't going to cut it. Can you explain why, what's behind this?
Well, that's certainly true, Bob. With yields at the levels they are, and in my belief, and I've been saying this, as you know, on CNBC a long time, this environment of low interest rates is not going to change. How is 1.5%, which is what the 10-year is right now, going to give you enough income? The dividend yield is higher on the S&P 500. Our dividend-weighted products are much higher, 2.5, 3, and some are even more, and they give higher return. We believe that the old 60-40 model just won't be able to cut it anymore. And that's why we recommend 75-25 as the equity fixed income allocation would be the best way for those approaching retirement to establish their assets, to get enough income and gain so they can maintain spending through retirement.
And you believe, this is a very important part of the story, I think, lower interest rates are here to stay. They're not some phenomenon the last few years, that this is going to be, this is going to be around for a long time. If that's the case, stocks are definitely, in many cases, a lot more attractive.
Yeah, absolutely. It's not, one thing I have to remember, it is not just the central banks that are setting interest rates down. It is powerful demographic factors, aging of the population, longer life expectancy, risk aversion, slower growth. All these factors are going to keep these interest rates in these levels very long, and you cannot survive on a 1.5% nominal interest rate. Look at the TIPS yields. The real interest rates are negative now. So it cannot maintain spending streams at all. Dividends on stocks are going to be the new bond in terms of thinking about retirement.
And Jeff and Jeremy, we have talked about this in the past. I get emails from the viewers, essentially what Professor Siegel was saying. It's the Tina story. There is no alternative. What do you want from me, Bob? I'm going to buy 1.6% 10-year Treasury yields. The S&P is yielding 2%. It does make some sense, if Professor Siegel is right, interest rates lower for longer, stocks are more attractive.
It does, and kudos to Professor Siegel and WisdomTree for coming out with this, but this really challenges Harry Markowitz. Remember Harry Markowitz back in 1952? He created the modern portfolio theory. So I think we do have to shake it up due to the interest rate environment, Bob, and right now this search for yield, I don't think it goes any way. Last year alone, of the 67 global central bankers, 50 of them ease. So I think when you continue to see this accommodative, easy mode, you have to find additional yield somewhere else.
Can you tell us a little bit more, Jeremy Schwartz, what's in these model portfolios? Presumably you're going to turn them into ETFs, is that right? I mean, where's this going?
I mean, right now we're making these models available on the major model platforms. We announced from the TD Ameritrade conference last week, the TD Model Market Center is one of the big platforms where all these model portfolios are available. And the idea is really marrying Siegel's 2 big books. So Stocks for Long Run was all about stocks having short-term volatility, but actually less long-term volatility compared to bonds, and that's upping your equity allocation. The second book that I helped him on a lot was The Future for Investors, which married high dividends, low PE investing, what we call the DIV directives, and that's what's in these models. There's emphasis on high dividend stocks, low PE valuation stocks, multi-factor diversification, because you're taking equity risk, you need to lower the risk within the portfolios, and there was also a heavy emphasis on being global and international, having a decent amount of emerging markets.
If we want to know more about it, we can't buy an ETF, though. It doesn't exist yet, right?
You got to go to the website, WisdomTree.com, and there's a advisor portal where you can get the allocations to these models, or for sure advisors on the TD Model Center.